Welcome to the Stock Market Palantir. Today we are going to talk about FOXX. Welcome to the debate. Today we're taking a look at Foxx Development Holdings, ticker FOXX. And this isn't just another stock analysis. This is, I think, a quintessential microcap case study. It's sitting right at this chaotic intersection of, complex SPAC structuring, some pretty brutal market microstructure dynamics, and, of course, that highly charged retail investor sentiment.
It really is. It's one of the most compelling and, well, frankly, terrifying examples of modern market behavior I've seen in a while. What makes Foxx so important to examine is this profound divergence between the company's operational reality, which is, let's be honest, it's dire, it's heavily commoditized, and the intense, completely non-fundamental speculative interest that's driving its daily volatility.
Precisely. And that divergence forces us to confront the central question here. Is Foxx fundamentally a doomed enterprise just destined for regulatory failure because of fatal financial performance and an imminent NASDAQ compliance issue? Or do its unique market characteristics, I'm talking specifically about that ultra-low public float, and the sustained retail conviction, provide a credible speculative path for massive short-term upside?
Well, are we taking the position that the overwhelming fundamental flaws, the deep operational deficits, and that very real imminent regulatory threat of delisting make this stock an unacceptably high risk, a classic value trap for almost any investor?
And all argue that the extreme volatility in its current, let's say, discounted valuation create a high-risk, high-reward speculative opportunity. It's one driven almost entirely by trading dynamics, and it's totally divorced from the slow, depressing mechanics of the company's actual balance sheet.
So let's start with that perceived discount you mentioned. Because look, at a surface level, the valuation does appear ridiculously cheap. We're looking at a current market cap of roughly $13.7 million against trailing 12-month sales of nearly $66 million. That gives you a price-to-sales ratio of about 0.2. Most stock screeners would absolutely flag that as deeply undervalued.
I acknowledge that extreme discount exists, and I take your point that it looks like a value trap. But let me propose a different perspective. That discount isn't just a reflection of poor health. It's the raw fuel for volatility. And volatility, for a trader, is the opportunity. The structural mechanics here are just so key. The public float, the shares that are actually available for daily trading, is exceptionally small. It's sitting at only about, 1.32 million shares?
That is a fact, yes.
And this low float characteristic, not the company's long-term strategy, is the primary driver of its volatility. It allows for rapid, exaggerated price movement through a trader's call float rotation, where even small amounts of capital can move the price substantially. This structural setup, it makes Foxx an ideal, high-velocity trading instrument, almost regardless of the underlying business.
But you can't just wish away the operational reality that justifies that low PS ratio. That $66 million in revenue, which I admit sounds impressive in isolation, is what I call empty calories. Foxx operates predominantly in the white label consumer electronics space. So think distributing unbranded or, minimally branded hardware.
Which means they're competing almost strictly on price.
Exactly. Without any brand premium, the competition is just fierce, and it absolutely destroys margins. Their own financials confirm this. You have revenue of $65.9 million, but the cost of that revenue eats up $61.1 million. That leaves a gross profit of only $4.8 million.
Which is a dangerously thin gross margin of, 7.2%.
And now, look at their operating costs. You take that $4.8 million in gross profit, and you subtract the $13.8 million they spent on other expenses. That's your corporate overhead, distribution, whatever limited R&D they might be doing. The result is a staggering net loss of $9.02 million. This company is structurally upside down. They're spending almost $3 in corporate overhead to generate $1 of gross profit. That is simply an unsustainable business model.
I acknowledge the negative margins, I do, and the operational bleed. But we have to discuss the narrative management is at least attempting to create. They are trying to pivot away from this commoditized distribution towards the higher margin Internet of Things, citing these strategic partnerships like the August 2025 collaboration on advanced smart water leak detectors.
A partnership announced in a very aggressive press release, I might add.
Well, look, whether that pivot is substantively achievable or not, and I grant the skepticism is warranted, that narrative provides a potential catalyst for retail momentum. For a speculative trader, that is the only fundamental news you need for a short-term trade, particularly in a low-float environment where any piece of news can be instantly amplified into price action.
That might fuel a short-term pop, sure, but it utterly fails to address the existential threat facing the company, which is the NASDAQ ticking clock. They received a deficiency notice back in November of 2025 regarding Rule 5550B2. This is a critical standard. It requires a minimum market value of listed securities, MVLS, of $35 million.
And they are currently sitting around, what, $13.7 million?
Meaning they must more than double their valuation by May 4th, 2026, or they face delisting to the OTC pink sheets. And if you combine this hard deadline with their delayed 10Q filing and the extremely negative reported EPS of around negative $1.40, you're looking at severe cash burn issues that rightly trigger a going concern risk assessment. This is the exact scenario that sets the stage for a classic financing death spiral.
I see why you define it so starkly, but for our listeners, let's quickly define what that spiral actually is.
Certainly. The spiral is this fatal loop where the company, constantly bleeding cash, is forced to issue new equity at lower and lower prices just to stay solvent. This dilution drastically increases the share count, which then further depresses the stock price, forcing them to issue even more shares the next time they need cash, and it just accelerates the collapse of shareholder value. This is the fate awaiting any fundamentally broken company that needs capital.
And that brings us directly into the core tension here. Let's start with the market microstructure, because this is where the popular narrative you see on trading forums just clashes violently with the official data. I mean, retail constantly cites an impending short squeeze.
I find that narrative to be, well, it has mathematically zero pressure. We have to confront this short squeeze idea with the hard numbers. The official short interest reported by FINRA is extremely low. It's only about 7,145 shares. That is less than 1/10 of 1% of the total shares outstanding, and it's less than 1% of the float. There is simply no pressure on short sellers to cover. The days to cover is totally insignificant. I concede that figure, 7,000 shares, is certainly damning for the classic directional short squeeze narrative. But that figure actually directs us toward a different non-fundamental driver that traders are watching, the volume itself. Retail investors often point to the high off-exchange short volume ratio, which is, consistently running above 60%. It is a technical fact, yes, but to rely on it is a category error. It conflates temporary market-making transactions with directional, conviction-based short betting. That 60% plus off-exchange volume just confirms that wholesalers and market makers are internalizing retail orders via trade reporting facilities or TRFs.
And just for clarity on what TRFs are,
These facilities, they handle transactions internally before they even hit the public exchange. So when a market maker sells shares they temporarily hold in inventory to a retail buyer, they need to report that sale instantly, and it's technically marked short for a moment. They then immediately buy shares on a lit exchange to flatten their risk and remain neutral. It's mandatory, transient, hedging volume. It is not a directional accumulation of bearish bets against FOX.
Okay, I accept that explanation of the plumbing, but let me return to the implications for trading psychology. While I absolutely concede the impossibility of a traditional short squeeze based on that minimal official short interest, the high off-exchange volume does confirm that retail investors, not institutions, are the dominant liquidity drivers.
And this retail popularity combined with that razor-thin 1.3 million share float creates the necessary conditions for a specific, different type of explosion, the gamma squeeze. That's a more sophisticated argument, I'll grant you, but explain the mechanism clearly, as it is heavily dependent on the option chain activity.
it is. So if retail traders aggressively purchase out-of-the-money call options,
And Foxx has had active options trading. The market makers who sell those options instantly become short gamma. This just means they have a deeply negative sensitivity to price movement. As the stock price edges up toward the option strike price, the market makers mathematically obligated to buy the underlying stock to hedge their now unfavorable position.
Forcing them to neutralize their risk.
Exactly. In a razor-thin 1.3 million share float environment, that forced hedging flow creates a powerful, self-reinforcing feedback loop. This flow, market makers buying the underlying stock to hedge options they sold to retail, it becomes a non-fundamental buying pressure. And this mechanism, though highly speculative, is how that massive short-term upside traders are looking for can actually manifest, even with negligible official short interest.
That requires enormous and sustained coordination of option buying, though, which is often difficult to maintain without a genuine fundamental news catalyst. Let's move on to the capital structure, because it imposes a continuous systemic drag on the valuation that works against any sustained squeeze. The company's public debut, as you know, was via a complex de-SPAC reverse recapitulation.
That's an important point of nuance, and one that's often misreporting online. The merger with Acri Capital used a 3.3033 exchange ratio for the legacy holders, and I bring this up because it's frequently mistaken for a reverse stock split, which often causes shares to drop, but this was actually an expansionary mechanism. This technical distinction, however, gets conflated, and sometimes it creates a psychological anchor for retail buyers who feel the stock is due for a return to a higher price.
I take your point about historical nuance, but we have to focus on the immediate negative implications of the current capital structure. The fundamental problem today is the latent supply of equity, specifically the public warrants FXWX.
Exercisable at $11.50.
That's right. And these warrants act as a powerful structural ceiling on the stock price. Even if a gamma squeeze somehow pushes the stock past, say, $5, any approach toward $11.50 would likely trigger warrant holders to exercise or sell, flooding the market with new shares and dampening that momentum instantly. And critically, institutional investors must use a fully diluted share count when they do their valuation analysis. That includes the warrants. And it just oppresses the multiple they are willing to pay today, severely limiting any long-term recovery potential. The structural ceiling from the warrants is, I agree, undeniably a long-term problem. But short-term traders aren't focused on the ceiling. They're focused on the floor defined by that compliance deadline. So let's address that most serious risk, the NASDAQ deficiency. We established the $35 million MVLS requirement, but I have to stress the difficulty of meeting this target. The management cannot simply rely on the typical microcap engineering fix, which is a standard reverse stock split. A reverse split only addresses a low bid price deficiency, getting the stock above $1. It does not solve a market value deficiency. The company needs to become fundamentally more valuable by $21 million in 5 months, which is, it's nearly impossible given their $9 million annual operating losses.
I'm not convinced by that line of reasoning, because the very unlikelihood of an organic recovery is what forces management's hand into the high-risk, high-volatility strategies that traders crave. The regulatory pressure compels them to attempt these desperate maneuvers.
Desperation is rarely a sound investment thesis.
It is for a trader capitalizing on intraday float rotation. Faced with a looming delisting, management has very few options but to aggressively try to generate volume and sentiment. This could involve, an aggressive series of press releases focusing on those nebulous IoT partnerships, or maybe even a desperate, highly dilutive merger to increase the aggregate market cap to clear that $35 million hurdle, even if it massively depresses the per-share price.
A desperate merger would just accelerate the financing dust spiral, but
I do understand your point. These attempts, regardless of long-term success, are pure volatility plays. They're aimed at generating the volume spikes and temporary positive sentiment required to clear that hurdle. A sophisticated trader capitalizes on that short-term action. The regulatory clock isn't just a threat, it's the mechanism forcing corporate action that creates exploitably large volatility, irrespective of whether the company actually survives in the long run.
So your entire argument is that the threat of fundamental and regulatory corporate failure is, ironically, the core opportunity thesis for a very specific risk-seeking trading demographic.
Precisely.
The business is fundamentally distressed, yes, but the stock is exceptionally structured to reward high-frequency, risk-tolerant intraday trading. That tension is unique to these kinds of microcap cases.
Then let's synthesize our positions. My core argument rests on the facts of the business and its structural liabilities. The combination of an unsustainable operational reality, that 7.2% gross margin, and the massive $9 million net loss, the structural capital overhang from the 1150 warrants, and that hard regulatory deadline by May 2026 confirms that FOX is currently fighting for corporate compliance, not for profitability. For any investor looking for value or long-term growth, the risk profile is unacceptably high due to guaranteed dilution and probable delisting.
And my position is that Foxx is to be analyzed primarily as a high-velocity trading instrument. It's suitable for those who can capitalize on the low-float volatility and are willing to frankly gamble on a temporary regulatory Hail Mary. The microstructure suggests this will remain a highly sensitive stock, driven entirely by risk appetite, sentiment, and options hedging flow, all independent of traditional discounted cash flow analysis. So the Foxx paradox requires us to view the company through two almost irreconcilable lenses: a fundamentally distressed consumer electronics distributor that is technically failing, and a uniquely structured speculative trading vehicle that, by its very design, invites explosive short-term moves. And that tension between the undeniable fundamental decay and the structural opportunities for volatility is exactly what makes Foxx such a critical case study in how modern market structure can create risk completely divorced from reality. The debate focused on whether Foxx's severe fundamental distress and regulatory threat outweigh its unique microstructure dynamics, like low float and retail sentiment, which provide potential short-term speculative opportunity. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.